Right here is a market reversal that happened at exactly 91% probability. And while other traders were guessing where the next turning point would be, this indicator showed the precise mathematical odds of where price would reverse. What's even more impressive is how this indicator doesn't just predict if a reversal will happen, but also calculates the exact probability of where and when it will occur using a 10 by 10 statistical grid. And in this video, I'm going to reveal this special indicator to you, show you the best settings to use, and give you 3 powerful strategies that'll transform your reversal trading forever. Let's get into it. To add this indicator to your chat, head over to TradingView and pull up any market you want. I'm using the 15-minute time frame on euro-dollar, but this works on any market, any time frame. Click on indicators and type in probability grid. Make sure you select the one by LuxAlgo. Now, this isn't just another support and resistance indicator you already know. Most indicators just show you where reversals happened in the past, but the probability grid uses advanced statistical analysis to calculate exactly where the next reversal will occur based on historical swing data. What makes this indicator so good is its 10 by 10 probability grid system. Each cell in the grid represents a specific price and time zone, with the exact probability of a reversal occurring in that area. So the further price moves into the grid, the higher the probability becomes that smart money will step in for a reversal. But here's where it gets really interesting. You can choose between 2 probability modes. The default beyond each cell mode shows you the probability of price moving beyond each zone, but the within each cell mode shows you the exact probability of the reversal happening in that specific area. This gives you surgical precision for your entries. Most traders struggle because they rely on random signals without a clear system. That's why we focus on structured strategies and automation, so you can study how these tools work step by step without guesswork or emotions. If you want to learn more and see exactly how these strategies are applied in real market conditions, click the first link in the description. Now, to get the most accurate predictions, let's optimize your settings. Double-click on the indicator to access the settings panel. You'll see the normalized data. I recommend you keep this enabled as it ensures fair comparison across different market conditions by using returns between swings instead of raw price deltas, because without normalization, recent high volatility periods would dominate the calculations, making your probabilities inaccurate for current conditions. Next, set your swing length to 20 for most timeframes. This determines how the algorithm identifies reversal points for its calculations. For maximum reversals, use 50 for enough statistical significance, because the more historical reversals you include, the more reliable your probability calculations become. Now, under probability mode, keep it on beyond each cell for reversal trading. This shows you the cumulative probability of price not reaching certain zones. Next, enable the dashboard and position it in the top right corner for quick probability reference. Finally, make sure Show Grid is enabled so you can see the complete probability map on your chart. These settings give you reversal predictions based on historical analysis with insane accuracy. Now, there are 3 ways the top 1% traders use this indicator, each one more profitable than the last. For trending markets, the probability grid excels at identifying high probability pullback zones. Look for trends where price is consistently making higher highs and higher lows, or lower highs and lower lows. When price enters the 80 to 90% probability zone against the trend direction, that's your reversal signal. For example, let's say you're in an uptrend. You'll first wait for price to pull back into the high probability reversal zone, then look for rejection candles or engulfing patterns. The beauty of this tool is that it tells you exactly where institutional buying will likely emerge. Enter your long position when price shows rejection from the high probability zone with confirmation from volume or candlestick patterns. Set your stop loss just beyond the grid boundary and target the next resistance level, or use a 1.5 times risk-reward ratio. For ranging markets, this is where the probability grid truly shines, because in sideways markets, price tends to bounce between established boundaries, making the probability calculations extremely accurate. First, you want to look for markets that have been consolidating for at least 20 to 30 bars to establish reliable probability zones. The grid will show you high probability reversal areas at both the upper and lower boundaries of the range. So when price reaches the 85% plus probability zone at range extremes, that's when you prepare for reversal entries. For range trading, wait for price to reach the high probability zone and show immediate rejection through wicks, doji patterns, or engulfing candles. Then enter your position in the direction of the reversal with tight stops just beyond the probability zone, target the opposite side of the range, or use the midpoint for partial profits. The mathematical precision of the grid makes range trading significantly more predictable than traditional support and resistance. Now, the most powerful application of this indicator is using it to anticipate breakouts before they happen. When price approaches the extreme probability zones, 95% plus areas, and fails to reverse, it's a signal that the normal probability patterns are breaking down. This often happens before significant breakouts, as it shows unusual institutional activity. First, you want to monitor price behavior when it reaches the highest probability reversal zones without showing typical rejection patterns. If price continues beyond the 95% probability zone with strong volume, this suggests suggests a high probability breakout is developing. Enter breakout positions when price closes beyond the extreme probability zone with volume confirmation. Set your stop loss at the previous probability zone and target measured moves based on the range or pattern height. The grid essentially tells you when normal market behavior is being overridden by institutional accumulation or distribution, giving you early breakout signals. Before I show you the next strategy, remember this: learning indicators is one thing, but applying them within a structured process is what really matters. That's exactly why we've created a place where you can review these strategies, see live examples, and study them in real market conditions. Just click the first link in the description whenever you're ready to explore further. Now, different markets require different settings for maximum momentum accuracy. For forex pairs, especially majors, set swing length to 25 and maximum reversals to 75. Forex markets have longer cycles and more institutional manipulation, so you need more data points for reliable probabilities. Focus on major pairs during London and New York overlaps when the probability calculations are most accurate. For crypto, use swing length of 15 and maximum reversals of 40, because crypto moves faster with more violent reversals, so shorter swing detection catches the relevant patterns. For stocks, set swing length to 30 and maximum reversals to 60. Stocks trend more consistently, so longer swing detection filters out noise while the higher reversal count improves statistical significance. Finally, for futures, use swing length of 20 and maximum reversals of 50 with special attention to session opens and closes when probability calculations are most reliable. Thanks for watching, and I'll see you in the next one.